So I'll explain in simple terms why investing is so difficult. Let's start off with the US index, for example, the S&P 500, 500 of the most productive US businesses. Over the last century, the long-term average annual return of the S&P 500 is approximately 10% a year. Now let's say you want to do better than that. You need to find a business with metrics that are better than that you understand, that have better financials and better prospects. Okay, so the best time to do that is during a stock market crash. So the businesses across the board, the price gets taken down. Regardless of how good the business is, prices just collapse 20, 30, 50%. So then you go shopping for a business you understand, that has a moat or something that protects it from competitors, strong financial statements, good prospects, good management, and you find it and you buy it. Now you own a low-fee US index and a business, ABC, that you think has better prospects than the market as a whole. If you are correct, then your average annual return going forward over the long term will be greater than 10%. Let's say it's 11 or 12. That makes adding the second business even harder because now the hurdle rate is not 10%, it is 12%. And not only is it 12%, the third business that you want to add on has to be significantly better than the market as a whole and as the business that you now have in your pocket. The business needs to be at least as understandable, has a stronger moat, better financials, and better prospects. Because if it has the same prospects as the market as a whole or your first investment, then there's no reason to add a new business. You just buy the index or you buy more of the first business you bought. You can see that as you add more businesses, it becomes increasingly more difficult to add something that will move the needle. And there's another layer of complexity. Let's say you're only investing $1,000. So to move the needle, you just need to make an extra $100, $120. But what happens if your investment portfolio is 1 million, 5 million, 10 million? Now with a 10 million portfolio, with a $10 million portfolio, now you're going to need to find a business that you completely understand, know in and out like the back of your hand. Super strong fundamentals, amazing moat against competition that will return on average on a $10 million investment over 1.2 million a year in order to move the needle. Otherwise, you would just invest in whatever you were doing before with the S&P 500, getting 10%. Because if you did nothing with the index and you invested 10 million, you'd get $1 million a year over a long period of time. As you add stronger and stronger businesses, the hurdle rate goes up. As your wealth increases higher and higher, you're going to have to invest more in order to get a return that even moves the needle. You have a $10 million portfolio. Who cares if you had a 50% return and you made 50 bucks? This is the problems that Warren Buffett has faced as he's been investing for the last 60 years. He is definitely a once in a multi-generational investor, and even his returns will start to flatline as better businesses are added on and it becomes harder and harder to do better than what he already has. As a result, he needs to invest more billions of dollars in order to move the needle. Right now, they have cash of almost $400 billion. So he's not looking to invest billions of dollars in a business that he understands that returns 1 or 2%. He needs something equivalent to everything they already own. What is going to move the needle when you own businesses like these in this amount of dollar value? And this does not even include all the private businesses that are throwing off cash to Berkshire Hathaway. And the final and biggest problem that most investors face that no one ever talks about is that you think that you have a business that's better than the index as a whole. What happens if you're wrong? Or if you're right for a short period of time, the business plateaus and then dies. 99.99% of businesses do not live forever. They grow, plateau, and they die. You could be right for 5, 10 years, and then you're wrong. Because you're now thoroughly invested emotionally, psychologically, financially into this company, will you notice that the business is deteriorating? Or will you ride a company like Kodak, Blockbuster, Nike, all the way up and all the way down? Meanwhile, the S&P 500 keeps chugging along, bad businesses are thrown away, new strong businesses are added back in. Investing looks like an easy game when you make money after 5 or 10 years, but try making money after 25, 40, or 60 years. Learn the reality about investing that most people have no idea about. Start here and discover 5 ways to become financially independent that you should have learned when you were in high school, but you didn't. So download my free newsletter linked off the bio. Good luck. Take care.